In this video, I'm gonna walk you through 7 strategies that most retirees never hear about or never actually use. And when these are applied correctly, they can dramatically increase the amount of wealth that you get to keep in retirement. Not because you saved more, not because you took more risk, just because you understand the rules and use them the right way. What I've learned after years of working with retirees, that most people do not struggle in retirement because they do not save enough. They struggle because once they stop working, they lose control of when and how their money gets taxed. That one problem quietly costs people hundreds of thousands of dollars over the course of their retirement. By the end of this video, you're gonna know what these 7 strategies are and how to start using them. Strategy number 1 is Roth conversions and tax bracket management. It's converting money that's in your IRA over to a Roth. Basically moving money that hasn't been taxed to money that has been taxed and will grow tax-free. It can be a very important strategy, but it needs to be done correctly. Otherwise, you're not gonna save taxes at all. The big reason to think about it or to look at it is because you're obviously going to have what's called required minimum distributions at either 73 or 75. And what happens is that the government decides a certain amount that has to come out of your IRA. It's dictated by them, you don't have control over it, and you are gonna get taxed at it. And so what a strategy can be is the time frame between when you retire to when that age is, as far as 73 or 75. You actually look at when you make money and you look at the bracket that you're going to be coming into, and anything that might be a little bit left over before you go into the next tax bracket, you take that amount and you can roll it from your individual IRA to your Roth, making sure that you stay within that same tax bracket. It's a management game as it goes along, because what you want to do is figure out which bracket you're in and try to be in the lower tax bracket, because what you don't want to do is wait too long and then now you're mandated by the government because of the required minimum distribution to be jumped up to the higher tax bracket. That's a tax you could probably avoid just by doing some management prior to reaching that date. Strategy 2 is capital gains harvesting. Really what that means is, obviously in a taxable account, you can have some positions that can grow dramatically. They can increase, right? It's not hard to look at a different stock that has done extremely well or a different investment that's done extremely well. Really what we're wanting to do is reset the basis, right? In a way that we can actually manage. And so really what we're trying to do is not be dictated later on in life when we're already having to take required minimum distributions and now we have to have that tax hit. What we want to do is try to manage that, and so maybe sell some of that position to bring down that cost basis. So we might sell, wait a little bit, buy back in so that we can actually lower our basis. So then when we maybe need that cash in retirement, we aren't having to sell and then have to pay a large tax gain. We can maybe manage that in a year when we have a lower taxable income or lowerable taxable year, so that we aren't hit later on in life when we have less control over it. Now, strategy number 3 ties into strategy number 2 quite a bit, in that it's tax loss harvesting. And really what it is we're still looking at selling gains to reset the basis. But really what we're gonna do on taxable accounts is look for positions that maybe have a loss or haven't done very well, right? And what we wanna do is kind of sell them at the exact same time so that we can offset the taxes we have to actually pay. So if I have a gain in one and I have a loss in the other, if I sell both, I can maybe offset the taxes I'd owe on that gain by the loss I have on the other one, and now I have a net neutral taxable bill on those 2 investments, yet I still have the same amount of money and I can readjust my basis in maybe the position that was doing very well. Strategy number 4 is delay Social Security while you're drawing on your IRA. This one surprises a lot of people, but if you're taking in money from your IRA or you're taking distributions, you want to try to stay in a lower tax bracket as long as you're maintaining the lifestyle and the income that you need. And so if we can delay Social Security and have it continue to grow like it does until age 70, during those years we could pull from our IRA, stay within a lower tax bracket hopefully, and actually be able to manage that, so then our IRA is much lower. When we hit the required minimum distribution age, we have a little bit more flexibility and we have a lower account value that we'd have to deal with as well, not getting hit with kind of a bomb in the end as far as having a big tax bill with Social Security hitting and us having to take the required minimum distribution. Now we have 3 more, so let's get into strategy number 5. It's charitable giving and donor advised funds. This is a very powerful one, especially if you're charitably inclined. It can be both before you reach 70 or after. If it's after, one of the big things that you can do is what's called a QCD, or qualified charitable distribution, out of your IRA. And that money can actually satisfy your RMD as well. But you can give up to $100,000 per year out of your IRA to a qualified charity, and that would satisfy your RMD, and there's no tax bill due. So it can be extremely powerful. Now, prior to that, or not qualified accounts, so taxable accounts, you can do a donor advised fund, and you can kind of do a bunching strategy. It's really a great strategy to think about because of the standardized deduction being so high right now. It's hard to itemize, but this is a strategy that can actually allow you to do it. So let's say you were actually wanting to give away money at like $15,000 per year, good amount, right? But now let's say you bunch it maybe 2 years or 3 years, which makes you're gonna put away $30,000 or $45,000. Now you easily have gone over the standardized deduction. And what you can do in the donor advised fund is it goes into there. You get the full tax deduction in regards to the amount that you put in there. And that money can be invested. You can actually send it out to the charities over the next 3 years. And then in the next 3 years, you can do the strategy over again. That way you can get the full deduction by atomizing and then go to the standardized deduction the next 2 years, helping with the tax bill overall. Strategy number 6. Real estate depreciation. For those of you who have investment properties, real estate depreciation can be a very powerful tool in the sense of that it's the IRS and the government that allow you to depreciate the property even if the house building that you have is actually appreciating. There's a set amount that you can do based on your profession of whether it's a full-time gig or not, but you can actually take money out of it and can help actually lower the tax bill on that investment property, and sometimes even against investment income. Lastly, strategy number 7, tax diversification. And this comes into play for most people who are actually preparing for retirement, maybe a few years prior to, even better if you do it sooner. But the fact is a lot of people come to me and they have one singular account. They have an IRA or they have a 401k, which is pre-tax dollars, which means any money that comes out of that for your lifestyle is going to be taxable, right? And so it's a little difficult to manage. And really what makes sense is to actually have 3 different types of accounts. Has nothing to do with the investments inside of them. It has to do with how they're taxed. So the first one obviously being the IRA and the 401ks, which is pre-tax money that grows tax deferred. Important to have and helpful with the current taxes bill as far as money goes in, gets reduced to your income then. The second one is a regular taxable account. You obviously have to pay capital gains on the growth, but you can have a lot of management, as we said before, as far as being able to do some of that tax loss harvesting or harvesting of the gains as well. Now, the third one being very powerful, and talked about it many times in the past, is regard to the Roth or after tax and grows tax free. Having those 3 can give you the most flexibility in regards to picking which account is going to help you in any given year to make sure that you can manage your tax bill and lower your tax bill, hopefully, in retirement. Every strategy we talked about today is completely legal. Every single one is IRS approved. There are no loopholes. They are the rules. You just have to know how to use them. And most people never get that conversation. The 7 strategies we covered today: Roth conversion and bracket management, capital gains harvesting, tax loss harvesting, delayed Social Security while taking distributions from your IRA, charitable giving and donor advised funds, real estate depreciation, and tax diversification across the buckets. These are not theory. These are things we do for real clients here at Bonfire Financial every single day. And if you want to sit down and look at your actual specific situation, what you are paying, what you could be keeping, and what real tax strategies actually look like for you and your retirement, click that link in the bio and book a call with me. It's completely free, and I promise you, you won't regret it. I'll see you there.